Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into our YouTube channel for our weekly video analysis. If you like this video, please give us a thumbs up and consider subscribing. So today we're going to dive into breadth because we had a 90% down day in SPY, and I'll show you what I think that means and what we need to get that turned around. Now we don't have a bearish breadth thrust, and I've got 3 breadth thrust indicators that I want to show. And then we're going to look at a new little twist on breadth by looking at differentials between the percentage of stocks above the 200-day in the S&P 500 and the S&P 600, and the percentage above the 200-day in the S&P 500 and the Nasdaq 100, because this can tell you who's leading and who's lagging within. So I'm going to start off with advances and declines because this is the most basic breadth indicator there is out there. It measures the degree of participation, and this is, of course, where you get the advance decline line, but we're not going to look at that today. So what we have here is advances in the S&P 500 and declines in the S&P 500. And you can see on May 12th, we had more than 400 stocks declining, actually more than 450 declining. So that means more than 90% of stocks in the S&P 500 were down. Now the S&P 500 is the single most important market barometer out there. There are lots of other ones, but if you had to pick one, it's got to be the S&P 500. And when you use advances and declines, it equals everything out. You know, an advance counts as +1 regardless of market cap, and a decline counts as -1 regardless of market cap. So these advance decline indicators are basically equally weighted. They're looking at a broad picture of strength or weakness. And so we had more than 450 stocks declining. And so then we get net advances, and that would be the number of advancers less the number of decliners. So we can see we didn't have very many advancers. We had a lot of decliners, so it's a negative number. It's below -400. And then we take that negative number and we divide it by the total number of stocks. And when it goes below -80%, that means more than 90% of stocks in the S&P 500 decline. This is AD%. Advances minus declines divided by total issues. And so what I think is significant here is we had this big down day in selling pressure on the 12th, and we had a rebound on the Thursday and the Friday last week, but we didn't get back above +80%. So that rebound was not quite as strong as that day of selling pressure, even though it was 2 days. We didn't get that breadth thrust. And if we go and we look at this period in late February and early March, it's a bit different. So here we get a -80% down day, a lot of selling pressure. So that's bearish. But then the rebound is immediately above +80%, a lot of buying pressure. And then we have another day of +80%. So we have 2 +80% days during this little pullback. And that set the stage for this advance in March and into April. But right now, I think this little 80% down day that we've had kind of gives a short-term bias to the bears, even though I think any pullback at this point is still a correction within a bigger uptrend. Now, these daily indicators are a bit noisy. They're positive, negative on a regular basis. And so what I do is I take that 80% indicator and I put a 10-day EMA on it. And you say, well, this looks noisy as well, and it certainly does. But the key is where you set your bullish and bearish thresholds, because what I'm looking for is a breadth thrust. Now, that 190% down day, yeah, it's a short-term issue because it shows the most selling pressure since March. So we could see some more downside follow through short-term. Now, looking over the medium and long-term, I use this 10-day EMA to smooth out that indicator and look for a breadth thrust that has more staying power, so to speak. And so with that 10-day EMA, I've got my bearish threshold at -30% and my bullish threshold at +30%. So anything in between is just ignored. And you can see here we got a -30% in early February of 2018, and that stayed bearish. We got another one in October, and that preceded this decline here. And then you can see, well, by the way, this is for the S&P 500, the S&P MidCap 400, and the S&P SmallCap 600. And so I look for at least two of the three giving some sort of a breadth thrust to turn bullish or bearish on the broader market. So we got all three going above plus 30% there in January 2019. We had another affirmation, if you will, in September 2019. And then in late February, we had all three going below minus 30%. And then in April, they got back above plus 30% to turn bullish. So these indicators have yet to trigger bearish, and I wouldn't become concerned about the bull market, so to speak, because we are in a bull market, unless we start seeing two of these three indicators trigger. So those two charts that I showed you are part of the Essential Breadth Indicator chart list, and this is available to subscribers of trendinvestorpro.com. You also need to be a subscriber of Stock Charts. But as you can see, there's 130 charts here, and I've already formatted them, and I've organized them in a top-down manner. So there you can see we got my big three breadth indicators for the major indexes, the big five indicators, and then a whole slew of other indicators that can keep you busy. And then we go into sectors and some industry groups like the gold and silver miners. So also at trendinvestorpro.com, this is the main analysis page. On Wednesday, I was looking at SPY and its gap zone, and QQQ gapped down a week earlier than SPY. And then I've got a couple of videos on trading strategies, how to trade a falling wedge, and how to trade the swing within a bigger pattern. And that's something you can use again and again, I think. Now, I also want to focus on a couple of differential breadth indicators, and this is measuring relative breadth, if you will, using the percent above the 200-day EMA. And we're going to do it for the Nasdaq 100 and the S&P 500. So what we've got here is we've got QQQ in the top window with the 50-day and 200-day. In this window, we have the NDX SPX ratio. And you can see that NDX was outperforming SPX since, well, for a long time, since at least October 2019. It was outperforming, got a little choppy there with the COVID crash, but then outperforming into September. And you can see that since September, it's been a bit of a rocky ride. This ratio chart has been flat, and the ratio went below the 200-day in March, and it remains below the 200-day. So this tells you that the Nasdaq 100 is underperforming the S&P 500. And we can see that in more detail within the index when we look at the difference between the percentage of stocks that are above the 200-day relative to the percentage of stocks above the 200-day in the S&P 500. So we've got in the red, we have the Nasdaq 100% above 200-day, and you can see there were more stocks above the 200-day than in the S&P 500 as they took off that March low. So that told you the Nasdaq 100 was leading, and it stayed leading. And then you can see the S&P 500 caught up there in November. And so we've got the differential down below between these two indicators. And so you can see that it was positive from January 2020 until November 2021. It went a little negative and then a little positive for a while and then deep negative in March. There you can see the percentage above the 200-day for the Nasdaq 100 getting below the percentage above the 200-day for the S&P 500 and staying below. So right now, 72% of Nasdaq 100 stocks are above the 200-day and 91.6% are above the 200-day for the S&P 500. And that differential is the most in years. Now, it could change. It's not going to stay this way forever. But right now, clearly, the Nasdaq 100 is the laggard of the two in both price terms with this ratio and breadth terms with these indicators. We've also got some issues with small cap breadth relative to large cap breadth. So here we have IJR, the S&P 600 iShares, and then we got the ratio of the small cap index, SML, to the S&P 500. And this ratio fell pretty steadily throughout 2018, 19, and into 20. And then it flattened out for several months and then took off there starting in mid-September, October, and then really surging in November. So this is when small caps were outperforming large caps when that ratio was rising. And if we look at relative breadth, this is the percentage of small caps above the 50-day minus the percentage of large caps above the 50-day. And we can see I've got a level here at 10%. And we can see we didn't get above plus 10% this entire time when it was underperforming. And on the downside, we got below minus 10% several times. There's just a lot of red on this chart. So that means fewer stocks in the S&P SmallCap 600 were above their 50-day than in the S&P 500. So that gave the edge to the S&P 500. But you can see this changed there in November when we got above plus 10%. And so now we've got more small caps above their 50-day moving averages than large caps. But this has changed again here in March when we've got this deep red here. So small caps are again underperforming. And then here we've got the difference, the 200-day moving average, 200-day EMA. These are EMAs that Stock Charts uses. And so we've got the percentage above the 200-day for small caps, less the percentage above the 200-day for large caps. And you can see it's been red pretty solidly for a couple of years. There were like two little blips into positive territory that didn't last very long when there were more small caps above their 200-day than large caps. And then it started to stay this way positive in December, but that didn't last long. So small caps are kind of like perennial underperformers. So we can also watch this ratio chart for clues on relative performance if we want to choose small caps over large caps. So what we have is we have a numerator, small caps, and a denominator, large caps. And so when that numerator grows faster than the denominator, this ratio rises. And then when the denominator grows faster than the numerator, that ratio falls, and that favors large caps. So here we haven't gone anywhere for a month and a half or 2 months. And what happens after this is key. If we break out to the upside, that's going to favor small caps. If we break to the downside, that's going to favor large caps. But right now, given what I'm seeing on this relative breadth here, I would favor a break to the downside. And that would suggest that small caps are going to underperform a little bit longer. So if you'd like to know more about trendinvestorpro.com, you can click on the link in the description below. If you like this video, please give us a thumbs up and consider subscribing. Thanks again for tuning in, and I'll talk to you again next week. Have a great day.